Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending Feb 25, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme, global turmoil with Russia and Ukraine and all the things that are going to come out of that. Let's take a look at where the markets have been and where they're looking at going over the next month, I think. It's kind of a good view that we want to take a look at. If you look at for the week here, you can see that the S&P NASDAQ Russell actually closed up for the week. That was due to the very strong reversal that we had on Thursday through Friday. Year to date, everybody's in the red. NASDAQ still in below 10%, so they're in a official correction territory. So is the S&P and the Russell, if you look at it off their all-time highs. But everybody's solidly in the red year to date as we wind down the month of April. You can also see that the best performing sector was healthcare. Energy is the best for the year. Worst performing sector, both for the week and year to date, is discretionary. All right, money is seeking safety, and that's what we should expect. And that is, in fact, what we're seeing. You can also see the forward PE ratio has come down a pretty good bit. It's down 19.49. It's still elevated based on a yearly average, 5-year average, but it's come down a good bit from where it was. Dividend yield in the S&P sitting at 1.41, and you can see the Treasury, it's at 1.98. So we're sitting here at interest rates looking to go higher. Yields, dividend yield on the S&P come down a little bit, so that increases the difference between the Treasury and the S&P dividend yield. All right, it's about 57 basis points right now. The earnings yield for the S&P is still at 4.68%. And if you take a look at the real yield, it's a minus 4.8%. That is due to the 7.5% high inflation that we got right now. And the current VIX, we closed the week pretty much where we closed the prior week. Okay, almost flat for the week for volatility. So that's a little bit about just a quick summary of the index notes and price action, right? And of course, if we look at the economic data, we can see this past week, NASDAQ swung 6.8%. So largest intraday range swing since the start of COVID pandemic in March of 2020. Primarily because there was some view that the Russians are now trying to put an olive leaf out there, or fig leaf out there, whatever you want to call it, to come up with some kind of negotiated peace settlement, because I think they've bitten off more than they can chew. And the other thing is the thinking being that with the weakness of the markets and the military move with Russia into Ukraine is going to force the Feds not to hike the rates as much or as fast. So already the Fed Fund Futures is predicting a higher probability of just a 25 basis point rate hike this in the next 3 weeks than a 50 basis point rate hike, which is where it sat about 4 weeks ago. Okay. Now, the other thing is the economic data. Even though it's taken a backseat to Russia and Ukraine right now, the inflation gauge, the core PCE, that's the personal consumption expenditures, that's the main one the Feds focus on. It rose 5.2% year over year, higher than January. And that is still way above where the Feds want it to be. Ideally, they'd like 2%, but I think that'd take 2.5 to 3%, but it's still elevated. So they're still going to come in hot with interest rate hikes. We are seeing pending home sales, they tumbled to a 9-month low in January, right? We got a very low inventory of homes for sale, lower affordability, people that can buy, mortgage rates going up. All of these things add to home sales coming down. Okay. Although we did see the PMI data for February that showed that U.S. manufacturing and services were growing, still at a pretty good pace. Consumer spending is still very strong. So that's keeping the markets, from falling even further, right? And of course, if we look at U.S. Treasuries, the Fed policymakers, as I said, they got to weigh a trade-off between financial conditions, mainly higher commodity prices because remember, Ukraine and Russia control leading grain exporters. Russia's a big supplier of aluminum, titanium, nickel, palladium, all the precious metal or the industrial metals. Germany also is suspending part of the construction of the Nord Stream 2 pipeline, so that's going to affect nat gas from Russia to Europe, along with sanctions. I'm telling you, all of these things are classic supply side energy shock, which typically bumps inflation even higher. So the Feds are going to be kind of weighing this balance, counterbalance on how fast do they get the interest rates higher and try and get inflation down without putting the U.S. economy in a recession. Okay. So they're still going to not be deterred from hiking in March, but I just don't think they're going to do that 50 basis point rate hike. So all of these things is kind of giving the markets a little bit of a boost. Plus the markets were way oversold to begin with. And like the US market shares in Europe also is, let me just get that on the screen for you. You can see everybody was in the red across Europe. The Euro stocks, 50 largest companies across Europe, the FTSE, the London markets, which by the way is the only ray of green year to date of the major indexes over in Europe. CAC 40, DAX, they're all down in the red for the week and for the year. Nikkei in Japan, China, Asia, the Asian markets also in the red dramatically for the week and year to date. Okay. So we're seeing all of this happen. Inflation is higher in the Euro economy as well. We did see the PMI across the Eurozone move to a 5-month high of 55.8 from that was from a prior lower PMI data in January. So we are seeing the economic data coming in more hot, but that's just going to add to inflation, right? So, and then of course, if we look at the Asian markets, Japan, they also adapted Russian sanctions along with Europe and the US. Japan, though, unlike the US, especially like Europe, they've got a lot of oil and gas reserves, so they're going to cushion any short-term blow to energy supplies. The Japanese PMI data showed that activity across Japan contracted a pretty good little bit in February, all right? But the government's buying up all their debt, their government debt. So that, it just keeps Japan in this 2-decade funk, stagflationary funk, I think. And then, of course, over in China, mainland China, they're still having major problems with their property sector. All of China's largest listed developers disclose monthly sales data reported double-digit drops in January. Meanwhile, the People's Bank of China is continuing to leave their interest rate steady, and they're putting money back into the economy like the Bank of Japan. So over in the Asian markets, Japan and China are really the only two central banks globally that are actually pumping money into the economy rather than taking money out. So that's a little bit about just a kind of a high level view globally. For our members tomorrow evening, we'll spend more time on just kind of where some opportunities do exist globally. But this is kind of what I'm looking at right now. And what I want to do is I'm going to take you over. Let's go take a look at the S&P 500 E-mini futures and kind of where we are and where we could go, right? So, as the screen comes up, like I said, I'm going to show you the S&P 500 E-mini futures, show you where we've moved to, where we could go, and let's just kind of play this thing out, right? So let's look and see how it's going to work for us. So looking at it, you can see that we actually hit a 2022 low this year. And if you look at the chart, you can see right over here that we were down 14.69%. Now, for those of you that follow me and you get my weekly updates here on the blog or in YouTube, you can see that we've been, I had forecasted a 10 to a 15% move lower, and that was back in Q4 of last year. I was talking about that for Q1, and this is kind of where we are right now. Be very careful of this big bounce here and move higher. We've got to clear a number of big hurdles on this daily chart for me to feel more confident in the market. These are just bounces off lows right now. We got a trigger here on a bullish divergence, which is always short-term strong, and we could have another move follow through next week to challenge the 200 and then the 50 EMA. We've got to clear these, but the key hurdle is going to be for us right around this level right here, right? That is a prior pivot high. Let me just clamp down on it. Right around 45.86 up to 4600. So I think we're going to have issues once we get north of the 200 and just south of the 50 EMA. You can see we got a lot of natural price resistance points right here to move through. If we can do it and then see this as a support zone, meaning there's follow through, then we can move higher. But we still got a lot of ugly charts out there that we got to make up for. I believe over the next 60 days, we're going to come and take these lows out before we finally settle in and move higher. Keep in mind, we got the Feds coming out in the next 3 weeks, and everything that they do in relation to inflation is going to affect these markets. The other geopolitical event, obviously, is Russia and Ukraine. Should that break out and expand to other countries, especially NATO countries, then the markets are going to get very ugly very quickly. So this is not a time. I mean, if you want to go in with a small percentage of your portfolio, if you're a long-term trader and you want to pick up some good stocks that kind of went out with the tide like everybody else, you can add to those longs, but be very careful because it's just a flip of the switch for this market to roll right back over. I don't think we're down to the downside yet, but we are in our group playing short-term signals to the upside. We got a signal the other day on Friday to play it to the upside. We were short going down here, and then we got a signal to get out of the short, and then we got into a long position here, and away we go. Okay, these are working out very nicely for us right now. So that's a little bit about where we're sitting on that. And if I come over here and let's just take a look at the Dow, you're going to see in the Dow, similar to the S&P, we're below the 50 and the 200. It looks like a bear market chart. You've got a downward vector on the 50, a downward vector on the 200, and we're bouncing up hard off the lows. We were down 12.67% off our all-time highs that were made on January 5th. So we've got to get through all of this mess. I think we're gonna clog down here in the brush, and we're going to roll right back over again. That is what I'm going to be watching for. So use this opportunity to recalibrate your portfolio. Short-term swing trades long, I'm okay with, but I think overall the market's going to go back lower again. We will know if we clear key hurdles here on all of these. In the Dow, I would put the 50 EMA. If we get over the 50 EMA and that holds, that'll be a key hurdle. Then I think we could come up in challenges up here around 35.7. All right, so that's a little bit about the Dow. Now, if we swing down and look at the NASDAQ, all right, NASDAQ literally came down, NASDAQ 100 futures came down into an official bear market intraday. All right, this is a daily chart. You can see we're down 13,000 and some change, down 22.31. We closed right back up here, which is just slightly on the border of a bear market. But then within the very next day, we moved here. Notice the 50 and the 200 both have a downward vector, and they are coming to cross. So typically when you get a 50 cross in the 200, generally price action tends to come back and test that cross zone, which should be at the lower end of an overall larger price zone resistance area for NASDAQ. Let's see how that plays itself out. Like the other indexes, I suspect we're going to move higher and then roll back over again, okay? If we look at the Russell, it's even uglier, okay? Let me just find the Russell on here. Where are we? There's the Russell futures. Where are we here? Here we go. Here's the Russell futures. You can see here we were down intraday 23.48%. We're probably sitting on the precipice like the Dow or the NASDAQ of being in bear market territory. The 50's already crossed the 200. This is what a bear market chart looks like. The 50's below the 200, price actions below the 50. What typically happens in a bear market, notice we got a bullish divergence here. That suggests we're going to get a counter move, which means a counter cyclical to the downside. We're going to come up, possibly take out the 50, come up and challenge the 200. But generally in a bear market scenario, you come and you challenge the 50 and or the 200, and you may hold it for a day, but then you roll back over again. So that is what I'm going to expect across all major indexes over the next week or two. Okay, now we may get a stronger rally, and we see some follow through here. So like with the E-mini, the S&P 500, which is the main one that we follow, right? If we look on here, I'm going to look for a strong follow through on both of these to get back north of 4586 to 4600. If we look at volume, notice on this volume chart, let me just make it wider so you guys can see it, right? The purple line is the weekly volume. The blue line is the monthly volume. So that basically a 5 EMA over a 20 EMA of the volume. And when the purple is above the blue, volume is getting stronger. So you can see down here in that bottom, a lot of volume came in. And look on this day right here. That's ideally what you want to see on a move higher, followed by strong volume. So there was definitely a buy the dip crowd coming in from Thursday into Friday. Thursday was kind of a let's flush out move to the bottom. Then buy the dip crowd came in and had a follow through on Friday. That is a good sign, but we still got a long way to go. And I believe we're going to fail up at this level up here. If we don't fail, well, what's it going to look like? We're going to get up above this area, do a retest of this area, and then move higher. That'll be my signal to get our guys, our members in our group even more long. Remember, we got a long signal. We got a short signal back over here, took it down, got a long signal right here. Now we're playing the bounce back up, right? So you want to make adjustments. And I've showed our members how to adjust option trade so you have a no lose trade, and that's the best kind of trade to have so you can sleep on a soft pillow at night, right? So that's kind of where we're sitting on these major indexes. And then of course, if we come over here and we look at volatility, it's basically flat for the week, but not without a lot of machinations. We came up and tested and actually went up to an intraday high here, and then we came right back down again. We're still in a down fast market mode, 27.59. We're looking at, I think, vol to come back down towards the center part, maybe the lower center part of this light rose colored zone, and then we can come back into the yellow zone again. So this is where we're sitting. We still got elevated volatility, and we're just watching where the action goes in Ukraine and Russia. That is the potential that can move the markets big time. The other, which could be a black swan event if it happens, would be if if China makes a move on Taiwan. If you think the move into Ukraine was bad for the markets, you have not seen anything near the catastrophe that would happen if China moves on Taiwan. Now you've got, because Taiwan has missiles that can hit Shanghai, and they would not be afraid to use them. So now you got a big issue over there, and then forget any ship coming to the U.S. with supply chain. So you want to see a supply chain problem, things will run out real quick when those ships stop sailing from the Asian markets to the west coast of California. Everything comes to a halt. So again, there's a lot of risk out there, and this is the very time when most retail traders get most bearish and when the markets tend to see the biggest bounce higher. All right, so that's kind of what we're playing right now. And of course, if we look at treasuries, bonds was a favored move when the market started falling. You can see how bonds moved up, but there's so many shorts here. Any move higher in bonds, as you guys know, we're a big believer in shorting the bond market. You can see the cross in the 50 and the 200. And it's attempting to rally, but every rally in bonds in our mind, in my mind, should be shorted, okay, or sold. So we're in the sell the rally mode in the bond market, which basically means you're buy the dip mode in interest rates, right? And here's the rates. And let me just see where that sits at 2065. So we've hit new 2022 highs right here at 2.065. We closed out the week at about 1.98. But when the Feds meet, I think as we drift through the month of March, you're going to see the rates go higher. But should the markets have a challenge to the already 2022 lows we made this past week, which I think it could happen sometime in the middle to end of March going into April, then we can see the interest rates go lower, bonds go higher, and that would be a perfect setup opportunity to play the reverse. Okay, members will be watching it very closely. Same thing with the US dollar. Anytime there's times of stress in the global markets, you can see here with the US dollar, we finally hit my target. Let me just move it on here. So you can see the dollar index hit a high of 97.73 right here. That was right on my target, but it's setting up for a bearish divergence. So any rally in the dollar, you should go long the euro, okay? Because when the dollar index gets up at these levels, the euro has fallen hard and is looking to rally. If we look at the euro, you'll see the same thing, but just the opposite, right? The euro came down and hit my target down here. Let me just try and get this adjusted here. Just like this, we came right down and hit my target. Perfect. We hit my target. We're setting up for our run back up. Remember, we were actually in the green year to date for the euro back just 3 weeks ago. And then we gave it all up. I think we're going to end up back up there again. But remember, if Russia expands its military invasion of Ukraine, more people are killed, it's starting to be prolonged, then the euro is going to be suppressed. And the dollar is probably going to be just go up slightly. But once this comes to an end, you want to be long the euro and short the dollar, or just long the euro, right? That's where you want to be. If we come down here and look at gold, the minute things settle down, obviously gold is going to pull back, right? It was definitely a fear thing. You can see when Ukraine came in and he ordered the move into it, it almost hit 2,000 and then it backed off. Longer term, gold's going higher, but it's going to digest this quick, fast move here. It's probably going to settle down here. Use any dip in gold to go long for this year. I also had told our members to play, there are a couple of different ways to play precious metals, and we're in one now. Longer term, and it should work out well. Same thing with interest rates and bonds. A couple of different ways to play that one. It's working out really nicely. But gold is another for this year and next. I think are going to be a good play. Oil, we've got a play in oil, a recommended play that should do really well. You can see the spike in oil when Russia came in. That would be expected, but oil does not want to stay up at this level. It hit 154 and then it pulled back to 91. That is a normal move when you get some kind of geopolitical event. If Russia ends up in a shootout with a NATO member state, expect oil to run up to 110 to 120. If the Ukrainian issue becomes extended, the Russian invasion becomes elongated more than a month or two, and then Western nations start increasing the sanctions and they start getting into the oil sanctions, you're going to see oil go up too. There's a great way to make this trade, members. I've talked to you about it before. I think some of you've got our trades on. They should work out really nicely. Okay, so that's a little bit about oil, but what that means also is for gasoline prices to go higher, right? So here's gasoline futures. In fact, I hadn't even updated it, but you can see here with gasoline futures, you know, it hit a high of 291. I think any pullback here is probably going to be bought, and we're going to see higher prices for gasoline futures also. Nat gas, well, nat gas is very difficult to get up above this level here. Part of it, and the reason why nat gas hadn't gone up yet, is Germany and most Eastern Europe or European countries, Eurozone, they're not really going after Russian oil. If they do that, you're going to see nat gas spike up here, probably even higher. So it's a very dangerous trade right now. It's just not worth the risk in making that play right now. Okay. All right, everybody. Net, there's a lot of risk out in the markets. short swing trades to the upside is kind of where we are right now. I expect the markets to move up a little bit more and then roll back over. A couple of counter cyclical moves, great trades getting ready to set up. For the long-term traders or investors, there's probably some really good stocks that are going to be set up for good buys because they're going to be good prices, but I would hold off just a little bit. I think they're going to be even better prices probably this time towards the middle of the end of March. All right, everybody, have a really great weekend. Members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.